know more about the valuation.
Yeah, but do you get such assignments in your practice, valuations?
To some extent.
Or out of your interest?
To some extent I have the opportunity to do valuation. But anyway, some areas are not, all the valuation principles are not using it. Some one or two cases are there which will be useful. So anyway, let us be, it is always told that it is we should be equipped to face any situation in future also. So
right.
I learn this valuation principle. I need not worry about it when the assignment comes to me.
Sounds confident sort of thing. Very good. But I'm sure Mr. Giridharan has shared with you that this is going to be a very coveted sort of designation or coveted title that we can add to our name when we say Certified Valuer from CA Institute. As times come by and as the company's bill gets cleared, I think there's one chapter 17 there which has a concept like Registered Valuer, and it's proposed that the members of ICAI who have cleared the valuation course would be included within that broad terminology, Registered Valuer. And if there are any government projects that can come to us, there are, even for banking sort of valuations and all, we can always get the benefit of doing or sort of empaneling on those projects. So we'll try to see how, I was telling them that we start from the grassroots and understand things from the basics, right? So let's see how we can understand. So like I said, valuation has to be a process. So it's very important to understand the purpose of valuation, right? You'll see so many sort of bullet points just for the purpose, right? Just have a quick look at it. I'll leave some of the slides with Mr. Giridharan, so you need not note down all the points. But wherever you feel something is of importance, you can note down, right? So it's sort of required in M&A, even like, you know, court cases, shareholder operation, allocation of purchase price under IFRS 3, business combinations, goodwill impairment, family partnerships, recapitalizations, business planning, ESOPs, compensation, marital dissolution, even for divorce, evaluation might be required. If you can help me with, in the previous class, Dr. Giridharan, has he discussed with you the standards of value, the premises of value? Has he discussed? Okay. Take some time to understand this. These are typically the 5 standards of value which are very important in any valuation assignment, but they are more from the US perspective, United States of America. In the Indian context, what I'm writing here would be the key standards of value. And wherever I'm using abbreviations, I'll see what this full form is.
Yeah.
Fair market value, fair value, market value, investment value, intrinsic value. I'm sure these are the terms we come across day in and day out in our practice and our professional experiences. So rather than my explaining what these terms are, what the definition is, like a book, sort of how a book reads out, let me hear some views, and if you can, if somebody can, you know, in their view, what do you think is the difference between fair market value and fair value? First of all, anybody? The more we participate, the more will be the intuitive learning, right? Inclusive learning, intuitive learning. Anything, I mean, we need not be right at the first instance.
Fair market value may be what market feels the value of, you know, what is the
what you can fetch from the market.
Yes.
And fair value may not be a market value, but how it may be a historical value, based on what is a fair.
Right, okay.
The buyer can, fair market value is a buyer can sell to, I mean, ready to buy that, that's a fair market value.
Yes.
And Fair value is what is the value which historically he has paid and brought that asset to that state.
Historical, then it becomes like historical cost convention, right? What he paid in the end, in the beginning.
And then what additions and improvements he has done.
Yeah, so that wouldn't be equated with fair value.
Yeah.
So that, yeah. Any
course,
other?
Income tax, we know only that fair value.
Fair value.
Rules
Yes.
talks about how you do valuation.
To share what I know limited about income tax, what they do is they follow rules of thumb. Yeah, they follow rules of thumb. They say 25% royalty structure for any sort of franchise arrangement. Generally, if in that industry, in that market, this is the royalty structure, they say this is the total business, 25% of that is the rule of thumb, so that is your income, presumptuous. In a lot of cases. So what were you sharing?
No, in income tax,
Yes.
predominantly, suppose somebody has to issue of shares and nowadays fair value compared with issue price.
Rule level.
Yeah, he's talking about rule. There is a definition called fair value.
Fair value compared to issue price.
Now, how to arrive at a fair value of a particular instrument? That is
Yeah.
a share. It's
Yeah.
a share.
Yes.
Individual share means shares.
Yes.
And what's the issue price? How to take? It's a different rule, set of rules.
Yes.
This is what I understand about fair value.
Yeah.
Fair market value, of course, I practically, which I have used some consultant using different method, tools, weightage and all that, arriving at certain fair market value. I don't find any consistency in weightage, any consistency
Absolutely.
all that. But there are certain, again I said methodology to weightage, I get different value, of course, it depends on weightage and assumptions.
Yes.
Market value, I understand it's only buyer and seller. So, similarly, other factors, intrinsic.
Good. That's in common. I mean, never be afraid of getting a different value altogether, because valuation is a subjective exercise. I can give a valuation report, I can give a value, ascribe a value to a particular assignment depending upon my experience, depending upon the purpose that I understood, depending upon my own sort of way of doing things, the approaches that I generally follow, and I sort of back it with management representations, caveats, and some sort of Bloomberg data, value line data, all that which I have used may not be used by others. So like I mentioned, the range could be pretty vast. Sometimes the range gives us, the highest to lowest point is in multiples. It's not even percentage difference, right? Somebody from this side was, yeah.
Combination of fair market value. Fair market value is nothing but combination of fair value and market.
Wow, good. You made it very simple for all of us.
Fair market value, I would say that is a value at which buyer is willing to buy anything which is sold without being forced for
Fantastic.
buying.
Yes.
There is no strings attached. So what is the value I will pay for something?
Very good. Yes.
Arm's length price.
Arm's length price. Good. Any other view? Yeah. Why this is very important is when we do any sort of valuation, unless we are clear about the standard of value that is supposed to be followed and that we follow, the value can be very different. When I say intrinsic value, it can be very different from investment value, can be very different from fair market value, can be very different from fair value. So what is the purpose? What is, yes, it is. Yeah, exactly. So let me try to share what I understand of the different, because these are the things, we'll broadly see what these mean in the US context. In Indian context, we'll come to what these are. So fair market value is the value that is ascribed in a transaction between a knowledgeable and willing buyer and a knowledgeable and willing seller without being under any duress or coercion, and they are knowledgeable and willing, they know about the facts and circumstances of that case fully, wholly well, and they are under no sort of compulsion to buy. If they do a due diligence, they feel that the value is not what they thought, they can walk out. Right? Fair value is more from the investor's perspective. Let me come back to fair market value. Fair market value is more from the investment perspective. Investment. What value should be ascribed to that particular investment? When I say that, it's fair market value. What a particular investor feels about the fair value of a particular asset becomes fair value to that investor. If a different investor tries to do an assessment,
So the investor perception comes into picture.
perception comes into the picture. In business terms, to understand the difference between fair market value and fair value, let's talk about a caustic soda company, right? And there are two sorts of bidders or suitors or potential acquirers to acquire that company. One is a chemical company, one is a bank, right? So for a chemical company, the value that it sees will have the fair value, the fair market value, plus it will have added synergies, which may not be the case with the bank. The bank is just buying to sort of, they have excess cash, they want to invest, they want to find out the fair market value and invest. But for this company, the fair value could sort of even include synergies that they feel in the business. That's another perspective to look at the difference between fair market value and fair value. Like I mentioned, a very easy way of remembering the difference is from the investment per se perspective, it's fair market value. From the investor's perception, every investor will have a different perception. It becomes fair value in his perception, right?
Can you say that fair market value, both the investor and investee kind of agrees with the price?
Yeah, I mean, eventually for any deal, both of them have to agree. So, but this is more from generally the buyer's perspective, because there will be suitors to buy, and that's where they do different sorts of due diligences. I'm giving you easy examples so that without getting to the technical side of it, once you remember from this side, it's difficult to like forget. Yes.
Can you say that fair value? You can say that the value of that particular asset or whatever investment depends on the interest vested between the parties.
Yeah, between the parties, that's the point he was trying to mention, that both of them have to agree, but it more comes from the party who is interested in acquiring it. They see different value based on synergies and how they can incorporate that company within us, how there can be cost savings, how there can be economies of scale. So for them, the fair value can be very different from the fair market value. They are even willing to pay more for those synergies, right? Market value is fair market value. But in certain extraordinary circumstances, the market conditions themselves are not fair. Take for example all our telecom companies. At what market caps they are ruling today, it's by no means fair market value. But it is the market value, what the market thinks, under all sorts of spectrum allegations and all that. But that's a market value. It's not from anybody's perspective. That's a market value. If anybody wants to buy out the shares of any particular company, they can go to the market and buy today. That's a market value. But it's not fair. So that's the difference between fair market value and only market value. Just to give an example. Investment value is having more to do with something like a fair value, but related to the example that we understood, the chemical company, caustic soda. So the investment value may not be fair value. It follows the hubris, the adamant nature, or sort of the pride or haughtiness of the acquirer, or the whims and fancies of CEOs to acquire a company for global sort of expansion at any price. I don't care, because it's not my money, right? So there comes investment value. I need to buy that company, whatever price. If there's a counter bid, I'll go and bid more. Like recently we are seeing Tata is trying to acquire Oriental Express, Indian hotels. So there's, I think, a counter bid, and Tatas are now willing to pay more. That becomes the investment value. It's neither fair nor market value, but you want to invest in that. You have decided that you're going to go for it. Like even when the Tata Steel acquired Chorus, there was rounds of bidding and cross bidding, and ultimately they acquired. So that cannot be said to be fair market value or fair value. That's their investment value, right? Intrinsic value, a very easy way of again remembering intrinsic value is what most of us mentioned here, DCF. When we do DCF analysis, we more often come to terms with what the intrinsic value or breakup value or net asset value or book value of a particular stock is. That is intrinsic value. And DCF analysis is the most common approach and methodology used to arrive at intrinsic value, right? I hope I'm sort of clear. Now in the US context, We understood fair market value, investment value, intrinsic value, which are pretty much the same. But what is this fair value, state rights, and financial reporting? Without getting too much into that, just broadly to understand, in US, the state laws are very stringent. Every state has a different law dealing with different asset classes, and different consumer rights prevail, right? Now, supposing there's a company which comes under a particular industry which is highly regulated in the US market, and the government plans to sort of slap a tax, extra tax on a particular company or a particular industry. So the fair value under in the state rights sort of from that perspective, it's the value just before the announcement of that stringent tax or a new tax, right? You get my point? There'll be a market value, right? And so long as it factors in that there can be factors in an expectation that such a thing can happen, it's built into the price, that becomes fair value from the state rights perspective. What happens after the announcement or after the confirmation of expectation is not fair value from the state rights perspective. For example, a stock is quoting at $40, right? Now there is expectation building that there will be a special tax on this company. So the stock price comes from $40 to $35, right? So we are here talking about $35 because the expectation of that new tax is already factored in at that price of $35. But that's the fair value factoring in the state rights. But actually when the tax is announced, the price can go to even 25 actually. But that's not fair value. That's under the present it's a knee-jerk reaction. You see my point? So that's giving credence to the stringent state rights that are present in the US. And financial reporting is what all of us know, US GAAP, IFRS, what we follow generally. Any question on standards? Because it's very important to understand. Every valuation assignment will have a different standard to be followed, and once we are clear, only then we arrive at the right sort of value. Yes.
IFRS, they always talk about fair market value.
Yes.
Is this similar to that, or this standard is different from the IFRS, what they define in that fair market value?
Yeah, this is that. Fair market value is what is used across IFRS and international financial reporting standards. So fair market value of this one, or now they are saying from historical cost convention we are coming to the fair valuation of all these assets. So interchangeably, in some of the standards you will find fair market value being used. In some of the standards you will see fair value of a particular asset. So both these are used across various standards. Fair market value and fair value. Yeah.
Yeah, but the definition is the same, right? Knowledgeable willing parties.
That definition is for fair market value. That definition that it remains the same. But now there are new definitions. Now what they are doing, just to share again, in US they have a Chartered Institute of Certified Business Valuators in Canada. Then you have CPA, then you have other forms of investment valuation appraisers. So all these societies, all these institutes have come together. They formed sort of a board, and that is taking a call on giving out new definitions. So you see more often new definitions coming for these terms. But broadly, that knowledgeable willing buyer, that sort of definition fits in the first one, the fair market value, right? When we say fair market value, mostly in all of the standards, that's what is defined as. Another important thing in valuations is the date at which a valuation is sort of performed, effective date, to mean more precise. So you can do a valuation today, but if the valuation is holding good as of 31st March 2012, that effective date becomes very important. And no report is complete without mentioning that this valuation is as of that particular effective date. Now that effective date can be 31st March, it can be 30th June, it can be 31st October, but that is very important. A value on 31st March can be very different from a value on 30th September. We all will agree under the present tumultuous market situations, right? Where was August market? Where was September market? And where was November all through, and the last week you see November again pick up, big difference, right? Valuation procedure. So broadly you can gaze through this. It's generally what all we discussed, the purpose of engagement, who the client is, client's use of the valuation like we discussed, determine the standard which we already discussed, premise of value. I think we should spend some time to understand premise of value. Was this discussed in the previous class? Premise of value?
The conditions in which we are doing the valuation, is it?
No.
There is assumptions and the limitations of
Yeah, but it's factored into sort of two broad premises we can discuss. Sorry, I'm using it. The two broad premises under which every valuation is done is either a going concern premise or a liquidation premise. So when an independent appraiser is called upon to do a particular valuation, and if the company is supposed to be continuing in perpetuity, we do a valuation under the premise of going concern. So when we do even the DCF analysis, for people who have had the experience of doing DCF analysis, we have a horizon period, right? Or the initial period where we have the projections for maybe 3 years, maybe 5 years, in some cases even 10 years. But what happens after that? We use something called terminal value, right? What is that terminal value for? For example, if the projections are only for 3 years, at the end of third year, starting from the fourth year rather, what we do is from the fourth year to perpetuity, we compute a value and add it to our valuation. Now that sort of valuations, that sort of approach is used under going concern premise. However, if the business is supposed to be liquidated, can we use a similar set of premise? We cannot. Can we use something called a terminal value? No, because the business has decided to close down. Now there are two forms of liquidation, even in the US. One is a voluntary, other one is a forced. One is the company itself decides that we want to liquidate, and other one is coming from the state, from the country, from the government, saying you have to close down. But regardless of whether it's voluntary or forced, in a liquidation sort of thing, what is relevant is neither fair market value, because you're not going to get your fair market value, nor fair value, nor your investment value. It doesn't matter at what price you sort of invested in those assets. So here what you will get is the net realizable value. You have all your assets with you. Generally what happens in